a very good morning to all of you on this nice, pleasant Saturday morning. The respected speaker, Shri Pinakin Desai, all the others on the dais, the protocol has already been set, and all the past presidents, and ladies and gentlemen. This is, as you all know, an annual lecture meeting which is looked forward to by all the professionals. This year, there was some doubt initially with the new Income Tax Act coming in, whether there will be enough material to discuss in a public lecture meeting. But as we have seen also from the initial budget speech, maybe it was not apparent that there are too many changes, but once you start going through the fine print, I was the other day checking with the chairman of our direct tax committee, Deepak Bhai, who was in the office preparing for the budget, that is there enough material? He said, yes, there is more than enough material if you really look at the fine print. So I'm sure all these aspects will be deliberated upon, all the amendments. I, on my part, being primarily an accounting and auditing person, am intrigued by only one amendment, one announcement regarding the proposal to now integrate the ICDS with the Ind AS. While on paper, it is a very laudable objective that to do away with two sets of books of accounts. Because see, during my practice, many times I have faced issues with my clients who are saying that no, but for tax purposes, this is permissible. I used to always tell them that accounting and tax are always totally different. Let accounting not drive your tax. Subsequently, to a certain extent, when Ind AS came in and the concept of deferred tax came in, this issue to a certain extent got solved, whereby the differences between the accounting and the tax profits also were taken care of. Now, I don't know how this announcement of entirely bringing everything in line with Ind AS, not even the accounting standards for other companies under the Indian GAAP. So we will have to see all that. So I would not like to take much time. As you all know, Bombay Chartered Accountants Society is India's largest and oldest voluntary body for nearly 77 years. We have a rich legacy, but we are also now changing with the times. Not only in terms of our membership base, but also in terms of our services which we offer under three broad categories: knowledge and education, the publications which we come out with, advocacy, research and representation, which is a relatively recent phenomenon. There is also some misconceptions as to who can be members, whether it is only people within the city of Bombay or whether on a pan-India basis. There are some such issues which are still there in the minds of certain people. And we want to now dispel some of those doubts by making, I wouldn't say changes to our identity or anything, but maybe a renewed focus on certain matters. And in that context, we have some surprise for you. There will be a short video which we will be playing for about 90 seconds, after which I will just speak.
49. A newly independent India was finding its feet, and in the heart of the then Bombay state, a vision was born. The Bombay Chartered Accountants Society began as a local beacon of excellence, but excellence knows no boundaries. As the maps of our states were redrawn, the footprint of BCAS grew even faster. What started in a single city began to echo across Bharat. Today, we are India's oldest and largest voluntary body of chartered accountants, a powerhouse of 12,500 professionals. Many think Bombay defines our limit. The truth? It's only our heritage. Our reality is much larger. With members spread across 400 towns and cities, more than half of our family serves outside the city of Mumbai. From the Himalayas to the Indian Ocean, we are there. We are the bridge between tradition and technology, between local ethics and global standards. We are no longer just a society, we are a national movement. To reflect who we truly are and who we serve, we introduce a new identity of purpose, BCAS, empowering the profession across Bharat. Join us as we leap into a new era, rooted in legacy, reaching for the future.
So this will be our new identity and a new tagline which will be going below our logo on a digital basis initially and subsequently physically. This was in line with the discussions which we had with the past presidents, and this we had a voting and polling on certain themes which were there, and this is what has been decided upon by the majority of the managing committee. So it is a new purpose and a new identity, and hope we will now be able to make an even more greater impact all over Bharat. So with that, I would wish all the best for this event. May God bless all of you, and may God bless our beloved Bombay Chartered Accountants Society. All the very best, ladies and gentlemen.
Thank you, Subin Bhai. We are now happy and privileged to announce the release of a research paper by Bombay Chartered Accountants Society jointly with IIM Mumbai. I would like to invite our past president and co-chairman of Corporate and Allied Laws Committee, C. Anand Bhatia, to brief us about the research paper on the group taxation in India and join us for the release. C. Anand Bhatia.
Good morning. It's a privilege to be here today to announce the release of BCAS IIM Mumbai joint research on a topic of group taxation. Not just it's an important milestone because we are releasing a research paper, but it's also a milestone in the intellectual journey of our society. At BCAS, we are used to making representations on immediacies of law and tax whenever there is a change, an amendment, a budget, etc. But this research is different in the context as well as in the impact that we want for this particular research. This is moving away from urgent to important. In the 75th year conference of Reimagine, when the keynote speaker, Shri Kumar Mangalam Birla, was asked a question that what do you see the vision for BCAS, his answer was very clear. For me, BCAS needs to step into the role of a thought leader. And that is where, post 75 years, I think we are moving towards that journey of being a thought leader for our profession and for the finance industry. The question on group taxation is not triggered by an amendment or a circular or a change or a judgment. It is a structural question where our economic realities and funding is happening through different subsidiaries. Can our tax provisions continue to work in legal silos? Is a question that we wanted to address. We don't expect immediate change out of it, but we wanted to get academic rigors and the power of evidence in international jurisdictions where group taxation has performed well. This research is an outcome of 6 months of hard work with the IIM Mumbai team and the BCAS volunteers. I hope this research sparks informed debates, constructive disagreements, and eventually thoughtful reforms. Thank you so much for everyone involved in this research, and may I request our dignitaries to release that paper now.
I now invite our Joint Secretary, C. Mandir Telang, to introduce our esteemed speaker for today.
Good morning, everyone. Our speaker today needs no introduction, but it is yet my duty and privilege to introduce to you Pinakin Bhai formally. He qualified as a chartered accountant in the year 1973. Currently, he is a partner in Ernst & Young and heads the Knowledge and Solution Group. Before that, he was a senior partner in P.D. Desai and Company. He was also associated with N.M. Raiji and Company, including in the capacity of a partner for 8 years. He was also a visiting professor in Narsimunji College of Commerce and Economics for around 8 years. Pinakin Bhai has contributed to the professional bodies and the Chamber of Commerce in various capacities over a period of year. When it comes to Bombay Chartered Accountants Society, Pinakin Bhai was a past president in the year 1987 and 88. He was thereafter the chairman of International Taxation Committee and Taxation Committee for the years, and also served as the chairman of various other committees for a number of years. As a part of BCAS committee member and the chairman, he has contributed to the record more than 30 technical papers at residential refresher courses of BCAS on the subject of taxation. He was also a vice chairman of the Taxation Committee of Indian Merchant Chamber, honorary treasurer of Forum of Free Enterprises, and independent directors on various board of companies. Pinakin Bhai was also the member of the editorial board of ICA and other committees. Over the years, he has also presented various research papers at seminars and conferences of ICA and many other professional bodies and trade bodies on the subject matter of interest and professional bodies. With this, I welcome Pinakin Bhai for this wonderful session. May I request Subin Bhai to present to Pinakin Bhai the memento, a certificate of donating 100 trees to the BCAS Tree Foundation project. Pinakin Bhai, request you to take the charge of the session.
The President, the office bearers, and all my dear friends here. So it's time now that we perform our part of the Kartavya, and we need to deal with, for the first time ever, during the times that we have been here, we will be talking amendments to 2 different acts on a consolidated basis. The challenge before the Finance Minister and the authority this time was that some provisions to the Income Tax Act 61 needed amendments, and at the same time, a yet to be born act taking birth on 1st April 26, as announced, we find that some amendments were needed to the provisions of an act which has not yet come in. I think a good balanced job has been done. But there is one concern which has been left behind. When there was a transition from the 61 Act to the 25 Act, some policy changes were made to the income tax bill. When matters went to the Joint Parliamentary Committee, some of these items of concern were not dealt with by them on the ground that they relate to the policy and they don't relate to the administrative matters. they concentrated themselves only on administration. In the process, there have been still some amendments sitting inside the 25 Act where one would have commented, one would have represented, and one would like to know why these amendments, which appear to be of a policy nature, have been made. Are they conscious or are they not conscious? Probably in one of the seminars which BCA might like to have, this could be a part of discussion as to whether there are unintended provisions in the 25 Act as a result of error on transition. With this, may we deal with principally the amendments which have been made to the 2025 Act. There are some which are common to 61 Act, 1025 Act, and we will understand them as if they are amendments to the 2025 Act. But if there are some amendments which are specific to 61 Act, I'll try to make a specific mention. We can begin with the framework of tax rates, which is customarily the way we always begin. I think there are very few occasions when one would say that there have been as such no amendments or proposals at all touching the framework of the income tax slabs and the framework of the rate structure. The slabs remain the same, the rates remain the same. Changes have been made in the sense that there is calibration of securities transaction tax that's more to control the urge of speculation through the medium of future and option rather than for the purpose of augmenting revenue. On the TDS and the TCS fronts, there have been either moderation or calibration of the rate structure, sometimes to bring about uniformity of rate of TDS. If at all anything needs a mention, it is that in respect of the overseas tour packages, TCS, which was to be 20%, has now been reduced to 2%. I think this is going to encourage the overseas travel. It would have been better to provide for some incentive to the people who travel locally rather than traveling overseas. We then find that the MAT structure, minimum alternative tax regime, there are some meaningful changes. With regard to the domestic companies, what it means would be that after 31st March 26, if you decide to remain within the MAT regime, then any MAT credit which you generate will not thereafter be available for set-off in the future years. It is at the risk of losing on the MAT credit that you can continue to be on MAT regime. And if you have any complaint against that, we are told that you better shift to the new regime, which is the concessional tax regime. This is as good as telling the people, the domestic companies, that you are not going to be part of MAT regime anymore. You are more or less compelled to move to the concessional tax regime. With this, you will find an end of an era that no Chapter 6 deduction is practically now be available to the domestic company. We grew up in the profession learning many provisions of Chapter 6A, but they will not be of any relevance for domestic companies from next year onwards. But this change should not have been made for foreign companies because they don't have an option to go to the new regime. It's available only to a domestic company. So you can't hit them hard in a manner in which you may hit a domestic company, I think probably, let's hope this might be taken care of. After this, may I introduce some provisions which are to be touched by way of introduction, but I don't have an intention of discussing them in detail. Either because some of the conditions by which the provision will operate are not yet announced, not yet available, or because they have very limited application and we need not spend our time on that. The first one is what the President introduced as a proposal of merging ICDS with INDS. How exactly is this to be done? What is the roadmap is not clear. But to the credit of the ministry, we have to say that as of today, we already have received an announcement that a joint committee which is contemplated to deal with the subject has already been formed, and they are moving fast in the direction of combining ICDS with INDS. I'm not sure how feasible it could be. My doubt is that the INDS regime is governed by IFRS regime. We needed approval and consent to have a provision even within INDS which is at variance with IFRS. In the light of that, if there are tax-oriented proposals which have nothing to do with accounting, will it be permissible as IFRS regime? If we still go ahead with the amendments to INDS, then we will find that for the purpose of accounting, people will still have to follow IFRS. The purpose of avoiding duplication of efforts may or may not serve a purpose. The second one is that under the Black Money Act, a disclosure scheme is being formulated. Under this, people who have hitherto not disclosed foreign exchange for a foreign asset or foreign income while being a resident taxpayer, they will have an opportunity of coming clean and avoid the penalty and prosecution. I am sure BCAS will organize some seminar where in a greater detail this item would be dealt with. The third one is a change in the safe harbor limit. Many of the rules relating to safe harbor, in their interplay with transfer pricing, the rules have been relaxed. A notable relaxation deals with ITAS services, the IT companies who provide IT-enabled services. Different forms of IT-enabled services have now been combined into one cohesive group, and in relation to all these IT-enabled service, safe harbor limit of 15% is proposed to be introduced. In addition to that, this is announced to be a self-regulated regime. You don't need an approval. And you can avail of this facility so long as your turnover is up to 2,000 crore of rupees, an increase from the current limit of 300 to 2,000 crore. So a sizable number of taxpayers in the IT sector can avail of this relaxation. We then have an amendment which will impact people and a foreign company connected with what we colloquially call as Apple Phones Assembly. It's a very mega project from the country's point of view, and that is always a matter of pride expressed when the ministry talks about this project. It has very limited application. But the essential point, what they want to do, with details to be kept aside, is that for the purpose of dealing with this project, the foreign company had to provide capital goods or toolings to the Indian company which is engaged in an assembly. There was an apprehension that on account of this activity of providing capital goods or stock or toolings, there could be some income attributed to the foreign company. I don't think that may have been the result, but nevertheless, there is an amendment made whereby for a period of 5 years, the foreign company will not face any litigation of attribution on the ground that the capital goods or toolings have been provided. I'm not sure whether this amendment was needed, but once it has been introduced, it might leave a shadow that after a period of 5 years, the tax authority will say that, look, this was always a taxable item, and 2030 onwards, we are going to levy our tax in respect of this activity. And the last item which we are leaving behind is the item dealing with data centers. On account of cheapness of cost, relative cheapness of cost, data centers in India are becoming very popular. We have the requisite labor. We have the requisite skill. Money can be funded within India or can be invited from overseas as well on FDI. Now, these data centers provide employment. Complementary to the data centers will also be the GCCs, the Global Capability Centers. We are told that these data centers will be governed by a safe harbor. In addition to that, a foreign company which is procuring services from data center, which are called data center services, then this foreign company will also not be taxed in respect of a defined activity. The function of a data center, as we know, is that the contents of a very large size, which are required to be manipulated or handled before the content reaches the customer of the foreign company, the contents are stored, collected, processed, and thereafter handled or delivered, distributed by the data center. What happens is that the foreign company procures the services of functions to be performed by data center on almost a concurrent or simultaneous basis. The output is delivered or distributed to the customers. There was therefore an apprehension that foreign company may be charged to tax on the ground that procurement of service is as good as resulting in delivery of services to the customers, and this requires taxability in India. Income can be said to arise in India. In order to protect them from such an apprehension, it is now provided that until 2047, you will not have any taxability in the hands of the foreign company, either on the ground that you are procuring the services, or better on the ground that this procurement of service enables you to deliver services and earn revenue from the customers. In all these cases, we will have to wait for some further rules and for some further conditions which are not available today. Let's come back to 3 or 4 amendments which deal with computation of income. A couple of them are relatively very small, and a couple of them will need some further enumeration. The first one is income from other sources, the dividend income. What is the expenditure admissible against such dividend income? Tax is normally payable on commercial income, the net income, not on a gross receipt. If a person is incurring expenditure by way of interest in order to earn the dividend income, he would borrow money, he pays interest, money is invested in the shares of a company, and dividend is received. Similarly, money may be invested in the mutual funds, income is received. This could either be equity-oriented funds or could be the debt-oriented fund. Hitherto, or as of today, the rule is that interest expenditure will be set off against the dividend income to the extent of 20% of income. If there is an excess, it is lapses, it is not allowed to be carried forward, but up to 20% of dividend income, it was admissible. We are now told next year onwards that no part of the interest expenditure, howsoever close may be the nexus between borrowing and the investment, it will neither be permitted against dividend income nor be permitted against income which you derive from mutual fund, including the debt mutual fund. Now this is somewhat harsh. It is running against the principle of taxing real income, that is taxing commercial income of a person. There are many provisions where tax is payable on gross amount, but in those cases, the rate of tax is calibrated. Here what we find is that there is no calibration in the rate of tax, and yet tax will be payable on the gross income. Now there is only one caution which is needed. We are dealing with a provision which is sitting inside the head of income, income from other sources. There can be some cases where a person may borrow money. He is investing money into the shares, say, of a company on the ground of commercial expediency. As an integral part of the business that you carry on, you are investing into the shares of a company. There are judicial decisions which take a view that if you are incurring an expenditure for the purpose of earning interest, for the purpose of earning business income, then the rules of deduction would be governed by the head of income, business or profession. So in some cases, one will have to keep a delicate balance and try to verify on an upfront basis whether you happen to be a person claiming interest deduction on the ground of investment being for a business purpose, or is it only for the purpose of earning revenue by way of dividend. The next amendment we deal with are relatively small but a very fair amendment. Deductibility of expenditure in respect of contribution to the provident fund, the employee's part of the contribution to his provident fund account. In a business enterprise, when salary is being paid, the employee is participating in a provident fund scheme. While making salary payment, the employer will withhold some part of the salary, namely employee's contribution to the provident fund. under Section 2 of the Act, amount which is withheld, which is kept by me as an employer in my custody, but for employee's contribution, at the stage of collection and withholding, it is treated as my income. Really speaking, it is not my income. I am receiving it as a liability. I am receiving it on trust, but under Section 2, it is treated as income. We are then told that when you deposit this amount with the PF account of an employee, you will get a deduction, and one will therefore neutralize the income as soon as he gets a deduction for contribution. The rule today is that to be entitled to claim amount as an expenditure, the employee's contribution must be deposited in the PF account of an employee strictly within the statutory time limit which is provided under the Provident Fund Act or the scheme. If there is 1 day delay in depositing the amount, I lose the deduction completely and I lose it on a permanent basis. This was rather harsh. In a matter which went to the Supreme Court in the case of Checkmate, Supreme Court interpreted the provision and said that, look, if you need a deduction, you will have to pay the amount strictly within the time limit which is provided under the PF Act. It has now been relaxed, and it is the old provision coming back. So the relaxation is that there may be a delay in payment, but ensure that you make payment at least by the time you have to deposit. Employer has to deposit his own return of income with the tax authority. So if I make payment outside the statutory time limit of PF Act, but before the due date of filing my return of income under erstwhile section 139(1), then I will qualify for deduction of an expenditure. The third provision affecting foreign companies, and a very fair provision dealing with correlative adjustment being granted in case of transfer pricing where APA has been secured by an Indian company. Take, for example, the case of an Indian company which is making royalty payment to a foreign company, and let's assume that royalty payment which is agreed is 1,000 rupees. As soon as an arrangement is reached, year 1, 2, 3, Indian company makes payment of 1,000 rupees to foreign company. When the case of Indian company is picked up for transfer pricing audit, the ALP is determined at 800 rupees. So the deduction granted is only 800 to the Indian company, but foreign company continues to be taxed on 1,000 rupees. Indian company might have applied for APA already. APA agreement is signed, say, in year 4, and APA agreement confirms that ALP is to be determined at 800 rupees. Now it's confirmed that the amount deductible will be 800. Steps will be taken for effecting the secondary adjustment. Extra money which has been paid to the foreign company over year 1 to 4 will be taken back by the Indian company. There is a repatriation. In spite of this, the foreign company used to suffer tax on 1,000 rupees. The argument could be that APA might have been signed by Indian company. It's not an agreement signed by foreign company, and therefore there is no mechanism by which foreign company can reduce its income from 1,000 to 800 even after having repatriated the excess to the Indian company. In order to arrest this, it is now provided that we will grant you to the foreign company the correlative adjustment. On the basis of a PA signed by Indian company, the foreign company can modify its return of income, and once it does that, its income will be brought down to the level of 800 and extra tax is paid will be refunded back to the foreign company. This takes us to a very wholesome amendment, a material amendment, taxability of buyback, I would say. The provision of law says that this is a provision which will apply in a case where a company is to purchase its own shares or specified securities which are issued by the company. The provision deals with a purchase. There could be some element of doubt and argument whether purchase is broad enough to include just a buyback, or can it include as well a capital reduction or a redemption or whatever. As for today, let's try to limit ourselves on an assumption that it applies to a buyback and does not extend to a capital reduction or a case of redemption. The intention appears to be to cover those transactions which result only in capital gains income to a person who tenders the shares, and we can call it taxability of buyback as of today for our discussion. Now, what is the rule today governing a buyback transaction? Company announces the buyback, shareholder will be tendering the shares back to the company, a certain agreed amount which is normally in excess of the cost of acquisition of shares to the primary shareholders will be paid to the people, and there is income in the hand of a shareholder because he receives something more than amount which he paid for while subscribing to the shares or while purchasing shares in the secondary acquisition. Today the rule is that the entire money received by a shareholder is to be taxed only as dividend income of the shareholder. It may be clinically so called income which arises because of transfer of a capital asset, but still what is provided is that a shareholder will pay tax on it as if it is dividend income. He doesn't get any set off in respect of cost of acquisition. The cost of acquisition will be regarded as capital loss to be adjusted or carried forward to the other year. So effective taxability will be as if it is dividend income. In respect of any purchase or a buyback, on or after 1st of April 26, the rule will be different. When shareholder receives that money, it will be recognized that he attracts the capital gains chapter of law. He has to work out his capital gains income by applying all normal rules which apply in case of computation of capital gains. And he will be taxed as per the rates by and large applicable to capital gains. If it is long-term capital gain, he is to be taxed on 12.5% plus surcharge. If it is short-term capital gain, he will be taxed on 20% plus surcharge. In addition to this taxation, there is to be additional taxation. But this additional taxation will be only in the hands of those shareholders who belong to the category of promoter. So a promoter participating in a buyback will pay tax at a differential rate compared to a non-promoter who is participating in a buyback. Now, in respect of the promoter group, we are told that if the promoter group person participating is a domestic company, then he will not pay tax at 12.5% or 20%, but he will pay tax at 22%. On the other hand, if a promoter person participating in a buyback is either a foreign company or a non-corporate entity, then he will pay tax at the rate of 30%. Whether or not this differential tax treatment in respect of promoters versus others does or does not amount to discrimination is for the legal fraternity to guide us, but where we stop is that a promoter group entity pays higher tax. Now, what will happen on account of this methodology? The first is, in a case where there was dividend income received by a company, the existing regime, we find that a company which receives buyback proceed can get Section 80M deduction by distributing dividend in turn. That facility will not now be available to a company. It will pay tax, but if it distributes dividend, you will find it still has to incur consequences of dividend taxation. Second is, capital gain income is to be computed as per normal provisions. Section 50 CA will apply, transfer pricing will apply, and in the hands of the company, Section 56 to 10 can also be tested. If I am entitled as a shareholder to some exemption, I will be able to claim that exemption. I may not pay any tax at all. For example, if I am covered by Section 47(4) as a shareholder, or if I am covered by a Mauritian treaty as a shareholder, and let's assume I am an eligible Mauritius entity, then I can claim complete exemption. I need not pay any tax on the transaction at all. A foreign company undertaking a buyback outside India can also have consequences if the transfer is covered by Explanation 5 to Section 9(1). And this leaves behind only one point of interpretation. The definition of a promoter is that, amongst others, a shareholder who has 10% or more of shareholding will be regarded as a promoter. Now, what is the meaning of a shareholding? Will it merely cover the equity capital, or will it cover shareholding on a totality? There can be a case where a person has more than 10% of preference shares, but he merely has minuscule of equity share. But will he be covered as a promoter, not because he has minuscule equity capital, but because he is interested in preference shares which do not come up for buyback at all. I think that's a matter which can cut both ways. We will leave it as a point of interpretation. The next provision, I think, welcome provision, and why it has been introduced, I am not quite sure. But we have items such as unexplained credits, the loan treated as income, unexplained investment, unexplained expenditure. Typically under the 61 Act, items covered by section 68, 69, 69A, B, C, etc. The rule today in respect of these items is this. If I am offering myself any income as part of my return of income and it falls in the category of unexplained credit or unexplained expenditure or asset, I pay tax at the rate of 60% on this. The normal rate of tax itself is 60% plus surcharge. If I have not offered income, but I am taxed on that amount at the time of assessment, then in addition to this tax, I also pay 10% of the tax and surcharge by way of a penalty. My burden can go up to around 78%. Now this law is to be replaced by the new law. Under the new law, we are told that if I am myself offering any amount in the return of income by way of unexplained asset, expenditure or credit, I will pay tax only of 30%, that is the normal tax rate, plus of course the surcharge. If I have not included that amount, but the officer taxes that amount, then the addition which is made will be deemed to be the tax evaded income. In respect of this tax evaded income, if I need any immunity, either I can litigate and say penalty is not leviable, it is not, I can't argue that it is not a misreported income, but I can say it's not leviable. But if I do not want to litigate and want to compromise and seek immunity, in addition to 30% of the tax, I have to pay 120% of 30, that is 36% by way of additional tax. So my total burden will be 30% plus 36% plus surcharge, which will almost equal to 75%. So for people who in case of doubt gracefully own up the income themselves in the return of income, either in the original return or in the updated return before you are caught, then you will find that the applicable rate of tax will only be 30%. This takes us to one more very healthy item, decriminalization of offenses. In the 1961 Act, there were innumerable provisions which dealt with prosecution. And people were always afraid. There was always an apprehension that for a very small venial default, a person could be prosecuted. The threat of prosecution is omnipotent when you go to certain officers who might be of a corrupt nature. It was an element of apprehension or a stress for meaningful promoters of high-rise corporates because they were feeling that at least a notice of prosecution could be issued to them. The stress was in the mind of the principal officer as well. Employer may not pay the amount. Music may have to be faced by the principal officer even after he has left the employment. Now, this is something which is not healthy. The government rightly recognized that there is too much of prosecution-related chapter in the Income Tax Act and we need some correction. Niti Aayog was given the function of recommending how to deal with the items of prosecution. Niti Aayog, in a very beautiful report that it presented, told two things to the government. Number one, barring very few cases, completely decriminalize the income tax law, because all disputes under the income tax law are in the nature of civil disputes and you need not have a provision for prosecution at all. Second, they said that even in those limited cases where you are retaining prosecution, the burden of proof should be on the tax authority and not on the taxpayer. Today, we have section 278E, according to which I have to prove that I am innocent rather than the authority proving that I am guilty of a certain conduct. So Niti Aayog wanted to reverse that provision of section 278E. I would say the government, not wholeheartedly, but at least half-heartedly, has gone ahead with accepting some recommendations of Niti Aayog. The law that we'll now find and that will apply to my mind to pending proceedings as well is that some items of defaults, we will not be enumerating them, but some 6-8 items have been completely decriminalized. There can be no prosecution. If at all, there can merely be a fine. With regard to a number of items, I would say a list of about 20-25 items, they have not completely decriminalized, but they have made suggestions, they have made proposals which will go a long way compared to today. We will be less worse off compared to today when it comes to prosecution. The proposals that the government has for us are, number one, there will not be a mandatory rule of imprisonment. The court is vested with a discretion that you may or may not impose imprisonment. You can make it up by a higher amount of fine. Second, if there is to be an imprisonment, it cannot be rigorous imprisonment, it has to be simple imprisonment. The third, duration of imprisonment will in any case be reduced. Say instead of 5 years, it could be 6 months to a year. And the value threshold have been substantially stepped up. For example, some imprisonment can occur or some fine can occur only if the tax evaded amount is say 25 lakhs or 50 lakhs compared to what used to be the limit of 25,000 or whatever in the earlier law. This brings us to a complete opposite scenario of something which is either unhealthy or disappointing. The retrospective amendments. 4 retrospective amendments, one of them dating back to 1st April 2007, one dating back to 2009, and the other 2 dating back by about 2-5 years. In principle, this government pretty well announced that we don't believe in retrospective amendment. The wounds of 2012 amendment by the Congress government were still live when the government took over in 2014. Over the last 1 or 2 budget, they made some provisions which covered a part of the running year, and we always had a comment that this is to some extent retrospective in nature, and now they have gone back by almost 20 years with regard to an amendment which reverses law enacted in 2007. I am not on merits of what those amendments are. It's now law. The government has power, the legislature has power to enact a retrospective law. I doubt whether we can have any challenge there against, nor we may like to have, because some of the provisions are quite venial. But take, for example, for understanding why we believe this is a disappointing development. Whenever a matter has been referred to DRP, DRP gives directions to the AO, and the current law says that AO has to pass an order of assessment within certain time limit after he receives the direction. Say, for example, as per interpretation of law, I may take a view that the time limit applicable is that AO should pass an order by Monday of the first week, whereas AO was of the view that he can pass an order by Monday of the second week. Government used to have an interpretation, and officers were wedded to a conduct that they will consider Monday of the second week to be the applicable rate by which he has to pass an order, whereas taxpayers used to argue that no, if you have not passed it in the first week, it has gone a time-barred matter. People had started filing writ petitions right in the year 2015-16 onwards. A writ petition filed in 2016, and there were quite a few hundred petitions. A writ petition filed in 2016 was taken up by Bombay High Court in June 22, and it was a favorable one in favor of the taxpayer. There was another High Court judgment. Matter went to the Supreme Court. There was a split verdict with two judges differing one from the other, and the matter was to be heard by a larger bank in February or March of 26. Now, in the background of this scenario, a retrospective amendment dating back to 2007 has been made by making what observations, which are quite instructive. The explanatory memorandum, while dealing with these four items, says that as per plain reading of law, there was no doubt in the mind of anybody that assessment will go, say, time-barred, only in the second week. Law was very clear that assessment time limit available is Monday of the second week. No doubt, plain reading of law. On some spacious grounds, views are being taken. They are aware differing views are expressed by the High Court, and even the Supreme Court is divided. Now, I think they are not consistent to say that no doubt can arise in the face of High Courts, tribunals, and Supreme Court leaning in favor of a different view cannot be said to be a matter where a difference of opinion was not available. If at all, they should have made retrospective amendment when warnings were given to them, writ petitions were being filed. Having waited for so long, I think it is disappointing that with these observations, the retrospective amendment is made. Now, what is likely to be the consequence? Depending upon where the matter is and which amendment you are dealing with, we will have to carry out an exercise of potential Section 234B or Section 220 liability in the hands of the taxpayers. The next one, a growing trend. What is happening today will become more and more frequent in the time to come, levy of mandatory fee. If a default is committed, there could be levy of penalty. Say, for example, tax audit report has been obtained with a delay. I may be exposed to penalty, but levy of penalty can never be automatic. I must be given an opportunity of being heard, and if there is a reasonable cause, penalty cannot be levied. It is now proposed that more and more items may be converted from penalty into a levy. The wordings used are, FAQ says, in lieu of penalty, EM says, penalty is being converted into a fee. Once there is a mandatory fee, as soon as there is a delay, unless you pay that mandatory fee, the income tax portal will not accept the income tax return itself. Whether the delay is of 1 day or of 1 month, penalty leviable by way of a fee will be the same. And no opportunity of being heard, howsoever compelling may be the circumstance or a reasonable cause, fee will become payable. Now, this is likely to be our life with the mandatory fee, and they are testing it. There are 2 or 3 items today. I am sure there will be 20 items in a period of another 3 to 4 years. Now, 2 interesting questions may arise. Number 1 is, what exactly is the scope of a levy, which is by means of a fee? Litigation has gone before the Bombay High Court in the context of Section 234E levy. And Bombay High Court there took a view that a fee is one which can be levied provided a service is being rendered. In the context of 234E, High Court found that this is a valid levy because there is an element of service which is involved in connection with a levy under Section 234E. Any item of levy which is now added might be tested on the parameter of is this for a service or is there no service element involved. I think in a delay where tax audit default has been committed by a day, it may not be regarded as an element of service, and we'll have to wait and see how the court looks at the matter. Second is that something which is called a fee. Is it really a penalty or is it a fee? When you are amending the law by observing it is converted penalty or that it is in lieu of penalty, would you consider it to be a penalty or would you consider it to be a levy? Now, this brings us to an extremely important point which we have not known before in India, but which is going to be part of our practice tomorrow. A combined order of assessment, the assessment and penalty to be forming part of the very same order. While it may be new to India, in the context of Income Tax Act, I think to an extent we find it in the GST law, and this combined order is what is prevalent as we learn from desktop research in UK, US, South Africa, as also Australia and other countries. What is happening today has been, which all of us know, but we'll examine the impact thereof, that in our scrutiny assessment, officer will pass an order of assessment. He just initiates the penalty in the course of assessment order. Penalty is not levied, proceedings are always stayed. Matter travels to CIT appeal to the tribunal. By the time the matter is disposed of by the tribunal, on an average, and no comment, but on an average, statistics-wise, 60-70% of the additions are either deleted or they are examined, refined and commented upon by the tribunal. Thereafter, the penalty proceedings are heard. Penalty order will now be levied in the light of wisdom which is available up to the tribunal stage. So compared to the raw data which we had earlier, the penalties will be far restricted in terms of impact and in terms of the efficiency of levy of penalty. Otherwise, on the basis of raw data, there would have been a blind levy of penalty. Now, as compared to that, the proposed new provision, the steps are not defined, but the way I feel from EM and the provision of law and the other normal logic or reasoning which one may apply, the procedure to me appears to be this, and I could be wrong. The procedure is that in a scrutiny assessment, the officer will deal with the assessment, and on a draft assessment order basis, he will conclude the assessment. He doesn't sign that order of assessment, but he communicates the draft assessment order to a taxpayer. In that draft assessment order, he would have initiated the penalty. When he communicates the draft order of assessment, he will also issue a show cause notice to the SSE saying that I intend to levy the penalty. I have initiated it as part of assessment order, which is draft, and the reason why I want to levy the penalty, to me, the reasons are this. When I receive the show cause notice, I have the benefit of the draft assessment order, which has entire reasoning for conducting an addition, and I also have the benefit of why he wants to levy that penalty. I will have a right of being heard. I go back to him with a reply which needs to be limited, I believe, only to the item of penalty. And I may not be allowed a fresh innings to re-agitate what he has written in the order of assessment. But the way it looks like, people will now submit also the errors on assessment. If he now modifies the draft assessment order, he might have to issue another show cause notice for the purpose of levy of penalty. But anyway, he hears me on the penalty aspect as well. He will now pass an order which will have 2 chapters or 2 parts. One, this is the assessment. Demand pertaining to assessment is XYZ together with interest. Second part is the order of penalty, and the demand raised will be PQR. There will be a singular demand notice, but 2 figures will be separated, penalty related and assessment related. If I intend to go in appeal, then I need to deposit 10% of the amount which is the assessment due, XYZ. I am granted stay of recovery with regard to the penalty, I need not deposit that amount until after disposal of the appeal by the first appellate authority. Now here, what is most dangerous will be the element of human bias which will come in. Stock additions will be made by the assessing officer. Look at the statistics available on the tax portal. What percentage of the demand is by tribunal stage eventually disposed of? You are increasing the burden on the assessing officer with regard to that entire 60-70% which awaits a deletion. Second, the maturity at the time of assessment is smaller compared to maturity when I am passing a penalty order after receiving the tribunal order. And the third, what I find is, they might be just automated, and my human bias will be that when I am passing 2 orders at a time, I want to strengthen the assessment order to strengthen the penalty. I want to strengthen the penalty order so as to also support the assessment. So it's a scenario where people may find difficulty of being faced with unnecessary litigation. The other item which needs attention is that once penalty is levied, it is now becoming a concrete demand. It has been stayed, but the demand is existing. So when at a future date, section 220 interest is to be computed, a factor of distinction would be that a demand which is existing, which is a statutory demand, has not been paid, it remains unpaid, and how to deal with section 220 would be a likely tricky affair. The burden will be more compared to what it would be today. And lastly, the corporate sector is also worried that as soon as demands are raised, you need to go back to the stock exchange and inform as part of LODR what the demands are. This can scare the shareholders who may not be as well equipped to understand the nuances of the income tax law. After this, we come to, reaching towards the end, we come to provisions of grant of immunity in respect of tax evaded income. When an income tax officer or assessing officer passes an order of penalty, he passes an order either to deal with unreported income, which is not misreported, or he passes an order with regard to a misreported income. So income assessed, it is of a bona fide nature. Addition is made because of lack of evidence. Addition is made where a difference of opinion is tolerable. This is not regarded as tax evasion. This is a disputed income. There can be another addition which the officer will allege it is in the nature of tax evaded income. Now let's assume what is happening today. A person makes 5 different additions. My returned income was 10 crore. 5 different additions are made, 1 crore each. Officer believes that 4 of the additions are of a legal nature and he doesn't trigger any penalty provision at all. He believes that the 5th addition, yes, there is some delinquency. I don't call it tax evasion case. It is a case of disputed tax, but I want to levy penalty in respect of the unreported income in the return of income. But it's not tax evasion. Today, I am entitled in such a case to own up the assessment, and once I own up the entire assessment, penalty which is initiated will be dropped. There can be no further penalty. There can be no further prosecution. I pay up the tax. I don't file an appeal petition. This is the provision of law today. People normally are not able to respond to this, and the main reason for this is that if I want to accept the assessment, I have to accept all the 5 additions, even though the risk of penalty is only with regard to one of the 5 additions. Now, this part of the law continues to be the same. There is no change. The change is in respect of the tax evaded income. Income where deliberately I have evaded tax. He makes 5 additions. Out of 5 additions, there is one which is in the nature of complete deliberate tax evasion, where today I cannot seek an immunity. I can't accept the assessment and say that, relieve me, drop the penalty, even though it pertains to tax evasion. But now, in a modified manner, it would be possible for me to seek immunity also in respect of tax evasion case. Number 1, I should not file an appeal. Number 2, I should pay up the tax as per the demand notice in its entirety. And third, in addition to the tax which I am paying, 100% extra amount will be payable by way of additional tax. If I do this, then I did not go for compounding of an offense. Not only the penalty, but the prosecution will also be taken care of. Now this pulls us to a couple of last small items. Sovereign gold bonds, the controversy which is created. Section 47 of the 1961 Act introduced a provision in 2015-16 where we are told, when that scheme of 2015 was introduced, we were told that if there is any capital gain which you earn on redemption of a gold bond, being a capital asset, it would be exempted. The law provided for exemption in respect of bonds issued in 2015 and exemption provided you get the capital gain on redemption. Question had arisen whether a person who is acquiring capital gain, a capital asset, in a secondary market, but is tendering them on redemption, will he be entitled to exemption? And the answer was yes. There was no condition that I should have bought on a primary basis. I could have secured also on a secondary basis. I acquire, compared to that I redeem, the difference will be considered to be the capital gain income which is exempt. After 2015 also, many different series of gold bonds were announced and issued. There was no amendment to the law. The law continued to grant exemption only for 2015 scheme and not for any other scheme. But the RBI, as also the ministry, had continued to issue the circular saying that the gold bond other series do also qualify for tax exemption. No statutory support as such, but there were assurances given by the ministry and by the RBI. Matter was running smoothly on account of instructions or whatever. nobody was raising any question. Capital gain exemption has been granted till date. Clinically speaking, this was doubtful because in 207 ITR, we have a Supreme Court decision in Builder Association case where it is said that an assurance which is given by an authority is not of any consequence, it doesn't form part of law. But anyway, matter was proceeding, everyone has enjoyed exemption, fine. There is now an amendment which is proposed, and this is raising a doubt for the past as also for future. The amendment now is that in respect of any redemption on or after 1st April 26, exemption will be available only if, number one, the investor is a primary investor. It was by means of a first issue, primary allotment, that I got the bond. And second, that I am tendering the bond only on maturity. Redemption is a premature maturity. It is not a maturity. So unless I have survived the full length, right from primary subscription up to maturity, I cannot get an exemption. A question which is now arising, let me tell you. And another clarification which is now offered, the change which is now is, that so long as you satisfy the condition of being a primary and terminal person associated with the bond, whether you are holding 2015 bond or 2017 bond, it doesn't make a difference. All the series of bonds will clarify. It is restricting us in the sense that new condition of primary allotment is added, which was not there earlier. It is helping us that compared to statutory clarification of 2015, now all the schemes are introduced for the purpose of exemption. Now in this background, if I am tendering my bond today, which I had acquired in secondary acquisition, do I qualify for exemption? Why, there can be a difference of opinion. I would believe that yes, you are most likely to qualify for exemption up to March 26. First, the condition of secondary acquisition was evidently not applicable in respect of the bonds issued and encashed today. Second, there have been assurances. CBDT will most likely come back with instructions or circular that will live with those assurances and will not trouble the taxpayer. And third, the very fact that in the amended provision, all the series have been included, this part of the law has been mentioned to be a clarificatory amendment. It should relate back to the earlier law as well, and I therefore feel that there are good chances of availing the exemption. This takes me back to probably the last of the items which we may like to consider today. Capital gain in respect of the transfers as a result of compulsory acquisition. We have a number of statutes in India under which there can be compulsory acquisition. At the central level, acquisition could be under, say, the National Highway Act, if the acquisition is for the purpose of highway. Railways Act, one can have acquisition if the purpose of acquisition is railways. In addition to 8-10 such other acts, we also find one General Purpose Act, a very long name, Right to Fair Compensation and Transparency on Land Acquisition, Rehabilitation, Resettlement Act. We'll call it Acquisition Law, a General Purpose Acquisition Law, under which for any public purpose, land can be acquired. Say, for example, for a smart city, if some acquisition is to be done, it will be done under this acquisition law. Income Tax Act today does not have any provision granting exemption in respect of capital gain upon acquisition by the central government under this law. But section 96 of that acquisition law has a provision which says that no stamp duty or no income tax will be levied in respect of such acquisition. We have a CBDT circular which is recognizing the impact of section 96 that tax exemption will be available in respect of this acquisition provided it is by the central government and under the specific acquisition law. If there is acquisition under the National Highway Act, exemption is not available. Under railways or defense, exemption is not available. But under this specific law, the exemption is available. The change made now is that that exemption is incorporated in the income tax law. Instead of relying on section 96, we will now be relying on the provision of Income Tax Act itself, where this exemption is extended. Now, one would have been happy if there was a line-by-line incorporation in the Income Tax Act. But there has been a mismatch in incorporation. When we refer to section 96, it allows exemption to each taxpayer, including a company taxpayer. Whereas, when we come to the incorporation, we are told that only an individual or HUF will qualify for this exemption. A question will therefore arise that so long as section 96 of the acquisition law has not been repealed or deleted, and if a company SSE were to receive compensation under this law, would it still qualify for exemption? I would believe that so long as section 96 is not done away with, though you may call exemption also available under the Income Tax Act, it doesn't take away the exemption which you may be able to claim by virtue of section 96 of the acquisition law. Now we find, and this has been our trend for the last 2 or 3 years, that when we hear the finance minister, we find as if we are rendered jobless, and the president was just expressing, do you feel we should have a lecture meeting because there is virtually nothing? Do you feel we should have a publication because virtually we have got nothing? But there are many different hidden items of agenda which come up as a surprise. That's a more impactful surprise compared to the surprise you gave us. And we remain busy slotting just for nothing. Let's wait and see what future beholds for us. Thank you so very much.
A great teacher is the one who makes difficult seem easy and easy seems interesting. Today's session by Pinakin Desai was one more example of his masterclass. I would now invite C.A. Kinjal Bhuta, Treasurer of BCAS, to propose a very well-deserved vote of thanks.
Okay, before we proceed to the other part and making other announcements, we would like to felicitate Pinakin Bhai with this live photograph of today's meeting as a memory. We've certain announcements to make before we proceed further. First of all, the budget publication is already available for sale outside this hall, and anyone who desires to purchase that can be purchased today. It will be available in BCS office from Monday onwards. Our research paper which we released today is also available on the official website of BCS, where you can scan the QR code and access the entire research paper. Beyond that, I would like to start by thanking our sponsors for today's event, Reliance Industries Limited and Cornerstone Venture Investment Advisors LLP, for their gracious sponsorship for this today's event. We have multiple events which has been planned in the next couple of months, and it's a season of having a lot of residential courses. So would like to announce a few of those courses. We have our 23rd Residential Leadership Retreat from 27th Feb to 28th Feb in Keshav Srushti. Beyond that, we have our 14th residential study course on Ind AS in Pune from 27th February to 1st of March. We have our 30th International Tax and Finance Conference, we call it as ITF. It is in Indore from 9th of April to 12th of April, and the bookings for all of these residential courses have already begun. So whoever are interested, kindly start enrolling for the same. Beyond that, we have multiple full-day workshops which have been planned. So we have a sustainability roadmap, corporate stakeholders and assurance, which is scheduled on 27th of March. We have our tech summit, which is there in Mumbai itself for 2 days, 6th and 7th of March, which is on the upcoming AI, so one can take benefit of the same. Beyond that, we have Mumbai Thane Express on Internal Audit 101, and we have our Writers Workshop, which is just around the corner on 20th February. Apart from that, we have a very vibrant students team, so we have an annual flagship event for students, which is Tarang, which is also there on 22nd Feb. So we encourage all of you to encourage your students and article students to please avail of that. And we have a blood donation drive, which is there on 13th of Feb 2026. So now, coming to the task, I think it is my distinct privilege to extend a heartfelt gratitude and vote of thanks to someone who has generously shared their time and expertise with us. Pinakin Bhai, once again, we have been beneficiaries of your immense wisdom. Your insights are always highlight of our event calendar. We look forward to the post-budget meeting. Your ability to break down the intricacies of the law into simplified way so that we can digest it is something which we deeply appreciate. While all of us are, right now striving or juggling to unlearn the deleted provisions, unlearn the Income Tax Act, learn the Finance Bill 2026, and relearn the Income Tax Act 2025 altogether, I think today's session has immensely added to our perspectives and understanding. So, on behalf of everyone present out here, I echo the thoughts of all of us, and on behalf of Bombay Chartered Accountants Society, we express our heartfelt gratitude to you today for giving your time and commitment to BCS year after year. And I request everyone here to give a huge round of applause to Pinakin Bhai. Thank you.